Welcome to another episode of TradeX Pro. Today we're about to dive into one of the most effective yet often overlooked strategies in the RSI arsenal, the RSI hidden divergence. You've already learned how the RSI helps you spot potential reversals through RSI regular divergence, but hidden divergence takes things to the next level. This technique is all about continuation. Instead of looking for signs of reversal, hidden divergence reveals when a trend is likely to keep pushing forward. Before we dive in, let's quickly revisit RSI regular divergence. This happens when the price and the RSI are moving in opposite directions, signaling potential shifts in momentum. Regular divergence comes in two forms. First, we have bearish divergence. Here, the price pushes to a higher high, but the RSI shows a lower high. This tells us that, while the price is climbing, momentum is starting to fade. It's a signal that buying pressure might be running out of steam, opening the door for a possible bearish reversal. On the other hand, we have bullish divergence. Here, the price makes a lower low, but the RSI forms a higher low. This indicates that, despite the price decline, momentum is building. It can signal that selling pressure is fading, potentially pointing to an upcoming bullish reversal. Now let's dive into hidden divergence and compare it with regular divergence side by side. In both instances, the price and RSI move in opposite directions, but the key difference lies in their patterns and the signals they provide about market trends. As shown in the diagram, these patterns differ not just in shape, but also in their implications. While there's no need to memorize them right now, it's important to grasp their meaning. You can always revisit this reference later for a closer look. Later in the video, we'll explore both bullish and bearish hidden divergence in detail. Next up, regular divergence signals a potential reversal, while hidden divergence indicates a continuation of the current trend. Based on our experience, regular divergence is generally easier to understand from a user perspective compared to hidden divergence. Alright, let's begin with number 1. Hidden bullish divergence. This pattern occurs when the price is rising and continues to rise further. The pattern emerges when the price makes a higher low while the RSI forms a lower low. It indicates that, despite a weakening in momentum, the price continues to rise. This divergence suggests that the bullish trend is likely to persist as the underlying upward movement remains intact even though the momentum may seem weaker. Traders can remember this concept with the following mnemonic: making the most of a tough day, and on a good day, even better. This helps illustrate that even when momentum weakens, the price still holds its ground, and in an uptrend, things tend to improve. Since this pattern is intended for a trend continuation strategy, make sure to use it during an uptrend. Next, let's look at some examples demonstrating hidden bullish divergence. In this example, the market is in an uptrend, as shown by the price rising above the 200-period exponential moving average. On your left, the price initially rises quickly, but then slows down towards the end. By dividing the trading area into two segments, we can observe that the first segment displays strong momentum, while the latter shows a loss of momentum. We mark two key points on the chart for both the price and RSI data. The first point corresponds to the previous low in price, while the second point shows a higher low. However, the RSI behaves differently. It is lower at the second point compared to the first. Since the RSI indicates weaker momentum while the price remains stronger, we identify this as hidden bullish divergence. This divergence suggests that the current upward trend still has strength, even though the momentum seems to be fading. It's a signal that the trend is likely to continue, giving traders an opportunity to anticipate the next move upward and position themselves accordingly before the market resumes its climb. Another example demonstrates the same behavior. First, confirm that the market is in an uptrend by checking the price relative to the 200-period EMA. Since the price is above the EMA 200, we confirm an uptrend. Next, observe the price movement and identify two lows along with two distinct regions. The first region indicates gaining momentum with strong upward movement, while the second region shows a loss of momentum. By analyzing these lows and their corresponding RSI values, we can forecast potential future price movements. The price is making a higher low, indicating that the upward trend is still intact. Instead, the RSI is making a lower low, showing weaker momentum. This meets the criteria for hidden bullish divergence, suggesting that the price may rise eventually. We can increase the success rate of trading with hidden bullish divergence by following specific guidelines. First, ensure that the price forms a higher low while the RSI makes a lower low. Next, confirm that both RSI points are within the regular zone and not in the overbought or oversold regions. Once these conditions are met and hidden bullish divergence is confirmed, you can consider entering a buy position. Now, let's look at more examples of hidden bullish divergence and analyze the optimal entry points for trades. The price is in an uptrend and continues to rise overall. We identify two lows at points 1 and 2, along with their corresponding RSI values. At these points, the price is making a higher low, while the RSI is making a lower low, indicating hidden bullish divergence and signaling trend continuation. However, instead of entering a trade immediately, we draw a trend line connecting the recent highs as a reference point. Once the price breaks above this trend line, we enter a buy position, anticipating further price increases. Similarly, in the next example, we observe a sustained uptrend with 3 lows. Each pair of lows could indicate a potential trend continuation through hidden bullish divergence. Let's first examine the pair at points 1 and 2. At these points, the corresponding RSI values are marked by 2 white dots. While the price forms a higher low, the RSI also forms a higher low instead of a lower low, which invalidates the hidden bullish divergence. As a result, we skip this pair of lows and wait for the next one to form. At points 2 and 3, the price forms a higher low, signaling a potential trend continuation, while the corresponding RSI forms a lower low. This completes the hidden bullish divergence pattern. We can enter a buy position using either the trendline break or resistance break strategy. For the trendline break, we wait for the price to move above the trend line before entering the trade. Alternatively, we can wait for the price to make a new high. Once the price breaks above the previous resistance, we can enter the position. Similar to the previous example, this one features 4 lows. The first 2 lows are invalid because the price is below the 200-period exponential moving average. When the price is below this moving average, the market is considered to be in a downtrend. Lows 3 and 4 are valid since the price is above the 200-period moving average. When we check the corresponding RSI, we see that the price is making a higher low, while the RSI is making a lower low. Remember the mnemonic we mentioned earlier? Making the most of a tough day. And on a good day, even better. This confirms a hidden bullish divergence. As before, we wait for the price to break above the resistance level before entering the trade to confirm the trend continuation signaled by the divergence. Next, we have number 2, hidden bearish divergence. This pattern appears when the price is in a downtrend and continues to push lower. It occurs when the price forms a lower high, while the RSI makes a higher high. This indicates that, even though momentum strengthens, the price shows no sign of rising. Hidden bearish divergence therefore signals that the downtrend is likely to persist. Just like with hidden bullish divergence, traders can use a simple mnemonic to remember hidden bearish divergence. Struggling on a good day. And on a bad day, even worse. This helps capture the idea that even when momentum improves, the price still struggles, and in a downtrend, things tend to get worse. To make things clearer, let's walk through some examples. First, we apply a 200-period exponential moving average to confirm the market is in a downtrend. As shown in the graph, the price is trading below the moving average, indicating a bearish market environment. The price drops sharply at first, followed by a pullback and a slowdown. We can split the chart into two sections. The first section highlights a sharp increase in downward momentum from the steep price drop, while the second section shows a loss of momentum as the price struggles to decline further. For hidden bearish divergence, we'll focus on the last two peaks and their corresponding RSI data. These key points will help us identify if the divergence is signaling a continuation of the downtrend. Initially, we have a high followed by a lower high, indicating a weakening price trend. The RSI, however, shows the opposite, forming a higher high. This discrepancy between price and momentum suggests hidden bearish divergence, signaling that the downtrend is likely to continue despite the temporary momentum increase. Let's examine another example to further illustrate hidden bearish divergence. The first step is to verify that the market is in a downtrend using the 200-period EMA. With the price trading below the EMA, the downtrend is confirmed. Next, identify two highs within the price movement and then divide the chart into two zones. The first zone demonstrates strong downward momentum, while the second zone shows a significant slowdown. We will analyze these two highs alongside their corresponding RSI data to identify hidden bearish divergence and confirm the continuation of the downtrend. On the chart, the price forms a lower high, suggesting a potential continuation of the downtrend. Meanwhile, the RSI shows a higher high. It indicates that, despite a rise in upward momentum, the price still struggles to advance. This confirms hidden bearish divergence, suggesting that the underlying downtrend is likely to persist. To improve the success rate of trading with hidden bearish divergence, follow these steps. First, verify that the price forms a lower high while the RSI creates a higher high. Then, ensure that the RSI values are within the regular range and not in extreme overbought or oversold conditions. Once these criteria are met, you can proceed with a short selling position. For the next three examples, we'll analyze the best trade entry points following the formation of hidden bearish divergence. In this example, the price drops sharply below the 200-period moving average, indicating a shift from an uptrend to a downtrend. During the pullback, we identify two highs at points 1 and 2, along with their corresponding RSI values. At these points, the price forms a lower high, while the RSI shows a higher high. This creates a hidden bearish divergence pattern, suggesting that the price is likely to continue its downward movement. To enter a short trade, we wait for the price to break below the support level, which will confirm the continuation of the downtrend. In the next example, we observe a similar scenario. The price shows a consistent downward movement with several pullbacks along the way. We focus on identifying two significant peaks during these pullbacks, along with their corresponding RSI values. As you can see, the price forms a lower high, while the RSI forms a higher high. This divergence indicates hidden bearish divergence, signaling that despite the increase in upward momentum, the price is likely to continue its decline. To enter a short trade, wait for the price to break below the recent support level and establish a new low, confirming the ongoing downtrend. Our final example involves three highs as shown on the chart. The first high is considered invalid because the price is still above the moving average, indicating that the market has not yet confirmed a downtrend. At points 2 and 3, the price forms a lower high, indicating a potential continuation of the downtrend, while the RSI shows a higher high. This creates a complete hidden bearish divergence. To initiate a short trade, wait for the price to drop below the recent support level and set a new low, thereby confirming the persistence of the bearish trend. In conclusion, hidden divergence reveals key insights into trend continuations. Hidden bullish divergence suggests an uptrend may persist despite weak momentum, while hidden bearish divergence indicates a downtrend is likely to continue even with a brief momentum rise. We've also covered 2 handy mnemonics to help you remember hidden divergence patterns. For the hidden bullish divergence, making the most of a tough day, and on a good day, even better. For the hidden bearish divergence, struggling on a good day, and on a bad day, even worse. Keep these in mind to easily recall the patterns and apply them to your trading strategies. Thanks for tuning in, and don't miss our next video for more cutting-edge strategies and insights. Keep trading smart and see you in the next episode.